Everybody, those of you coming in, just making sure that the audio is coming through, and we'll get started here in about a minute. Looks like we've got a good sized group joining, so. And it seems everybody can hear me. So if you can't hear me, it's probably a you thing. I guess you couldn't hear me say that either then, so I guess that's okay. My screen sharing. Dustin, are you able to see my screen?
Yeah, I can.
Perfect. Okay, we're at 1 minute past, so I think that's my cue to get us started. So thank you all for joining. We've got a pretty good sized group and continuing to grow. So that's great. We had about 75-ish people registered for the webinar. So we'll have a very diverse group as well. So this will be fun. The purpose of today, the webinar is to if you've never attended a CalcuQuote webinar, we really focus on industry education, so focus primarily around electronics manufacturing. We're going to spend only about 10 minutes max at the end of the presentation talking about CalcuQuote solutions. But the purpose of this is education focused, not commercial focused. So if you do end up wanting more in-depth information about that, of course, we're more than happy to talk to you about CalcuQuote stuff. But today we're talking about inventory. So before we get started, just a few logistical items, and it looks like, here we go, I'm going to end this poll here. Logistics about the webinar software here is you can use the chat, you can use the Q&A, you can use the polls, you can add reactions, things like that. Use all the buttons, make this interactive. That'll make this fun for everybody. It doesn't have to be just me and Dustin talking the whole time. We're very open to this being a dialogue. The second thing is, because this is usually the most common question, is that a copy of the slides and a recording of the webinar will be made available to all attendees. So this is being recorded. And then the final thing is, of course, at the end, if there are other topic ideas that you'd like us to cover in the future, feel free to email us about that. We're always happy to kind of speak to what's on the industry's mind and do some research for you. So yeah, okay. With that, let's start off with some introductions. Some of you may already know me. My name is Chintan Sutaria. I am the founder of CalcuQuote. I'm based in Dallas, Texas. And before CalcuQuote, I worked in EMS. So I have some direct hands-on experience working for contract manufacturing. And now in CalcuQuote, we're primarily focused on the supply chain and quoting side of the business. Dustin?
Yeah, thank you, Chintan. Good morning, good afternoon, good evening, depending on where you're at in the globe. My name is Dustin Carlson. I joined CalcuQuote in May of this last year. I reside in northwestern Minnesota, way up in the corner, about an hour south of the Manitoba border. Prior to CalcuQuote, I was 17 years in electronics distribution, various roles of management, working with sales teams, spent a lot of time visiting and going on site with EMS companies and OEMs. Additionally, I spent a lot of time working on a digital strategy, and CalcuQuote was a great fit for a next chapter in my career, as it was a very important partner for the company I left. So,
cool.
Happy to be here.
Thank you, Dustin. Okay, so you guys are here to talk about the topic of the day, which is inventory has doubled, now what? So We thought the heading of this, the topic here would resonate really well with the industry, and based on the number of people registered and attending today, it seems like we definitely struck a chord. The way we're going to structure this is we're going to start really high level and abstract. So we're going to talk about the problem at large, and then we're going to work our way down to being more granular, more actionable as we go, right? So we're going to start off wide and then continue to narrow down. So what that means is we're going to start off with some high level trends. We're going to talk about this golden screw story that everybody is always talking about. We're going to frame the problem, so we're going to apply some business theory and some definitions, and then we're going to have Dustin take over. He's going to talk to you about some specific actions that are in your tool belt, as well as some resources that can be there for you. So let's move forward. Let's talk about trends. By now, of course, I don't think anybody on this call, just based on looking at who's here, is going to be surprised to hear that there were shortages for the past couple of years. Probably most of you are also not going to be surprised to hear that there's been some softening of demand and some increased availability of parts in the last few months. So based on that, it seems kind of counterintuitive that we'd now be having, on the one hand, we're talking about shortages and softening demand. On the other hand, so it seems counterintuitive sometimes to say that, well, how can you have excess inventory? How can you have so much extra inventory when parts aren't available? And so the term golden screw comes up a lot in this explanation. So I'm just going to go through what that looks like. So the term golden screw is used to describe the most valuable part on the bill of material, right? What that basically means is the most valuable part, according to somebody much smarter than I am, is the part that you don't have at the moment, right? So if I have a 100 line item BOM, then the one that I don't have is the one that's costing me the most money at this time. Putting that into kind of a process diagram here, say you have, 100 parts on a bill of material, and even if one out of those 100 parts isn't available and you didn't know that in advance, then you may end up buying the 99 parts, but not have what you need to be able to ship the finished assembly and generate revenue for your business, and therefore generate cash for your business. And it also doesn't matter if the 99 parts become more readily available, because without that golden screw, nothing's going to happen, right? So the problem gets worse and worse as the industry recovers from allocations, from shortages, from volatility, because there are, especially in the current climate, there are some parts becoming more available, but there are still some golden screws out there that stop the entire job from being able to move forward. And as other parts become more available, suppliers ship them to you, right? So you get those parts, and some of those parts are NCNR. So this line of red dots, which is those 99 parts coming in, starts to elongate, right? So some parts become earlier and earlier and earlier, other parts become later and later and later, and that's where more and more of your working capital gets tied up. All of this you probably already knew, so treat those last 3 minutes of explanation as a therapeutic session. Hopefully now we can all feel a little bit happier that this is an industry at large problem, so not just isolated to your business. I'm going to talk a little bit about how this stuff is supported by data that we see in CalcuQuote. So what we did is across hundreds of electronics manufacturers and tens of millions of searches being done on the CalcuQuote platform, we started doing some data analysis to say, okay, what can we do with this to get some insights on behalf of the industry? So I want to just show you a few data points here. So the first one, this is a chart that we started compiling right before COVID. You can see, so it starts in January 2019 and ends as at the end of January. But what you can see is there was this big wave that happened where lead time started increasing, right? And we really started to see it at the tail end of 2020, and then it just continued to go up and up and up. Now, at its peak, it was basically double what the average manufacturer lead time being reported was. And then it peaked at Q3 2022, and now it has dropped for 5 consecutive months, right? So we're in the 5th month now, and although the data is not shown here, it continues to decline, which is on the one hand, good news. It's a little bit of return to normalcy, but it's when the curve goes up and when the curve goes down that you start to experience the effects of volatility. So it's going down. Does that mean we're done with the issue? No, unfortunately, we're not. So here is a second chart. So this shows insufficient stock in the market. And so the basis of this calculation is a customer searching on the CalcuQuote platform says, I want 100 pieces of component XYZ. Is that readily available for me to have access to it from the distributors that I have tied into my CalcuQuote system, right? And what this shows you is in the past, it was, at its best, it was around 10, 15%. And then it starts to get worse. And the 10, 15% relatively normal because you have things like incorrect part numbers, custom made parts, things like that. So there is always going to be some of that. But ideally, you don't want it to be at its peak. I think we were at like 37%. And that starts to feel really painful for a lot of people. So I would say we're still at a pretty high point. I think based on the chart here, it's about 25% was the number from the previous month. So, definitely some parts still not being available. Now, the next chart I want to show you, I got permission from a colleague here, Ed Smith, who's the CEO of a company called SMTC. They're a multinational company based out of Florida. And he presented these slides at the IPC EMS Leadership Summit a few weeks ago. And I thought they were so good, I thought I'd share it with you guys with his permission. This is the first slide, and it's going to look a little bit small here, but what it shows you is that this is the North American sales performance compared to prior month, right? And the data is coming from ECIA via Ed. So basically, it shows that component sales in all categories were climbing really high, right? So this is compared to previous months. So anything above the green lines means that sales were growing. So they grew. And then starting in about Q3 of last year, they start to constrict, right? So from a month-to-month perspective, of course, there's shrinkage starting to happen starting in Q3, but before that it was growing. And since everybody has sales numbers to hit, a high sales record means that's just the new number to beat, right? So I don't think anybody gets satisfied at saying, well, we did so well for the last year, let's take the foot off the gas now, right? So you can definitely expect that the industry as a whole wants to have a push to regain some of that traction. Second chart I want to show you here, same source, is that this one's interesting because it shows cancellations have continued to accelerate over the past couple years, right? So this is saying that the number of cancellations that happen has continued to accelerate every month. It's increased in volume month over month for a while now. And the story behind this, probably pretty obvious for people in your shoes, is that if I'm looking for part number XYZ, I can go to supplier A and supplier B and say, hey, ship it to me whenever you get it. Well, whichever supplier ships it to me first, I'll cancel the other one, right? And especially during times of volatility, that becomes fairly common. Normally, this is fine, but in some cases, you start to see that materials become NCNR, and you can't cancel those, you can't reschedule those. And in those cases, you start to end up having to hold inventory that you didn't necessarily want. And with the acceleration of canceled orders, especially in the last 6 months, so that's this portion over here on the right-hand side of the graph where it really starts to peak, we can expect that practically suppliers aren't going to be able to tolerate 50% increase in cancellations month over month every month, right? And so you can expect that the industry as a whole will become less forgiving of canceling orders because everybody's business starts to suffer and that there's a lot of waste in ordering something and then canceling it. All that's to say is, yes, suppliers are feeling pressure to sell product and make sure that you accept the shipment, regardless of your golden screw problem, right? If you're on the purchasing side, then yes, you want to cancel and move things around, but suppliers are going to need you to accept shipments. That's the reality of it. Now, there's of course competing factors here. And this wasn't as evident, I would say, during the allocations process because people were just happy to be able to have product to ship, right? Like if you got parts, you're like, all right, well, it's a good thing I at least have the part. Now I can feel secure about one day being able to build this thing. But now as inventory becomes more readily available, demand starts to soften, No one's going to just say, oh, let's throw in the towel and accept lower performance. Yeah, I think this problem continues to go. There's a question here of, is there a correlation between sales performance and insufficient stock? That's a good question. I would say sort of. So this is insufficient stock, and really to get apples to apples comparison, this chart starts at the end of 2020. So let's say all of 2021 and 2022 are covered in here. So that would mean you're looking at the right half of this chart. So yes, sales was high at that time, but it's hard to say if sales was high in the previous years because I don't have the data of 2020 as a control base, right? So the flat portion of insufficient stock, we don't have the data for sales performance during that time. Good question, though. Okay, so I'm just going to do a quick poll here. So you guys are going to see something come out. Let's see here. This is just, again, the continuation of the therapy session. Does your company's experience support this hypothesis? Want to make sure we're on the right track, talking about the right things here. Okay, quick poll answers here. Okay, I'm going to say, but this is going to be kind of like calling the results before all the votes are in, but you guys can, I think I can share this. I'll share this. You guys should be able to see this, but it looks like with about half the people reporting in, it looks like nobody thinks we're way off base here, right? It's either strongly agree or agree. So good, we're on the right track. And if you disagree with this narrative, I'd be open to that discussion too. So yeah. Okay, let's frame the problem then. So the macro level data is interesting, right? It helps tell a pretty compelling story here. And it explains the circumstances of the industry. But mostly, most of my time is spent talking to business owners or business executives, things like that. And at the end of the day, if you own a business, if you're running a business, if you have a job to do, your job is, regardless of what happens to the economy, I got to weather the storm, right? So your job is to solve the problem and remain competitive despite what the macro level data tells you, right? So, economic indicators are nice to pontificate on, but we got to do something about it for our business to survive, kind of thing. So we're going to get into, how do you look at the dials on your business? And for that, we're going to talk about cash. So some of you may have heard this saying before in the form of cash is king. This is, I don't know where it came from, but it's another smart person. And also I'll add that there's some irony in using a picture of Benjamin Franklin to use the word king, but I digress. As we've established, there's good macro level story behind why inventory levels are increasing. And the reason you're all in this webinar is that you recognize that that's bad for business. But the root of the inventory problem is that inventory ties up liquid capital, right? It's tying up your cash. The more inventory you have, the less cash you have to do other things like paying employees, buying equipment, investing in expanding your space, things like that. And since inventory isn't the only thing that ties up or frees up cash, we're going to take a look at the entire cash conversion cycle. So those of you who may not have heard that term before, I'm just going to spend a few minutes talking to you about the definition of cash conversion cycle. So cash conversion cycle is a financial metric. So those of you on the finance side of the business, you've probably heard this, but it basically measures how much time a dollar stays tied up before it's brought back in, right? So imagine your business as a cash making factory. Well, how much cash do you have to put in for the business to now spit cash back out to you? And that might be, if you're profitable, for every dollar put in, you get more than $1 back. And if you're unprofitable, then every dollar you put in, you get 90 cents back. Either way, it's the cycle it takes for it to go through that. So let's go into a little bit of detail about this metric. So cash conversion cycle has three main components to it. So the first one is days sales outstanding. The second one is days inventory outstanding, and third part is days payables outstanding. And we're going to dive into each one of these individually. But another way to think of this is DSO is accounts receivable, DIO is your inventory, which for an electronics business is usually a very substantial portion of this. And then DPO is days payable, so it's accounts payable. So those represent the three ways that your cash can get tied up. Let's go into each one of these. So we're going to start with DSO. So DSO is how long does it take you to receive payment after a sale, right? So if you're an EMS company, imagine that you've finished building an assembly and you ship it, you invoice your customer. How long before that invoice turns into cash in your bank account, right? In this case, a lower number means that you get paid relatively quickly after a sale, and a higher number means you get paid relatively slowly after a sale, right? So that's, at its core, that's what DSO means. You can break it down into a bunch of different categories as well and get really nuanced with it. One of the questions that I usually get asked after webinars like this is, well, what's a good number for this, right? And I'll say, at least I can speak for the companies that I've worked with in the US, fairly typical is that EMS companies typically do net 30 or some variation of net 30. But practically speaking, you're not going to get paid just because your payment terms are 30 days, you're not going to get paid at the 30-day mark. Usually, for a variety of reasons, you can expect to be paid around the 45, 50-day mark, right? So that's what I typically would say is a healthy number is, or maybe not healthy is the wrong term, an expected number is if you're around 45 days, then you're probably on track with what we see in the industry. The other thing I would also mention is it's important to evaluate trends to detect deviations, right? So kind of like the longitudinal graph we had about lead time and stock and things like that, I would say you want to be tracking days sales outstanding over a period of time so that you can say, oh, is it increasing? Is that why my cash is being tied up, or is it decreasing, or is it staying flat? Okay. Next one, days inventory outstanding. So days inventory outstanding is how long it takes for you to turn your inventory into a sale, right? So imagine a part has come in the door, your receiving person has received it, you are now liable to pay for it. Then you're waiting until you can send an invoice of something you built with that part, right? So that's what's measuring, that's what we mean by days inventory outstanding. A low number here is a good thing. It means that as soon as the part comes in, you build the stuff and you ship it. That's great. Higher number here means it's a bad thing. And then I'll also add here that I don't have a clear answer for you about what's a good number because there's so much, it depends based on your business model. So we have companies that are really quick turn prototype focused, whereas other companies are production focused. So that can create very different scenarios because you might be building large batches on the production side or really small batches on the prototype side. So you might want to have different benchmarks for success. Similarly, if you're focused on flexibility for your customers versus efficiency and lower price, and also the mix of consigned business versus turnkey business can have a big impact on this as well. So several different things that can impact the definition of what a good inventory turn number is. One thing I will say is I've seen this on numerous occasions, so I call this out especially, is that don't blame the stockroom for the inventory levels, right? A lot of people go to the stockroom, they see a bunch of extra parts there and they say, stockroom, why is there so many parts here? The stockroom didn't buy the parts. They don't get to decide when the parts go out the door, right? So if you're looking for somebody to talk to about your inventory, purchasing decided when the materials came in, or at least they were the responsible party for it, and production or sales gets to decide when the materials go out. So stockroom keeps track of where the inventory is. So if you can't find the parts, yeah, talk to the stockroom about it, but don't blame the stockroom because there's an increase in inventory. Second thing is that you can break this number down. So I mentioned on the AR side, you can break it down. Same thing with this one. So I've seen versions of this where you say, what's my WIP inventory outstanding? What's my finished good inventory days? So you can break that down as well. And then this final point I'll make here is consider your definition of inventory and make sure that it aligns with cost of goods sold. So what I mean by that is are you baking in cost of labor in your inventory? Are you burdening that inventory and WIP with labor? If yes, then you want to take that into consideration. Same thing, it should parallel what happens on the cost of goods sold side. So if you aren't doing that with your inventory values, then you want to make sure that your cost of goods sold number also doesn't take into account labor and things like that, because otherwise you'll have non-parallel calculation there. Okay. Final point here is days payables outstanding. So this is basically how long do you have to pay your vendors for the inventory that you bought. So you can see the other two are tying up cash, right? Days sales and days inventory is like it's the red, that means you are tying capital in. The green here, it's subtracting out days, because your vendors are giving you payment terms. They're giving you time to pay them after you receive the materials. So for example, if I receive the part and I don't owe my vendor for 90 days after I receive the part, well, depending on my days sales and days inventory, that might more than compensate for all of the inventory capital that I have tied up. So just something to consider, as days payable is actually in your favor. So in this case, a high number is a good thing, unlike the other two, because it means that you have plenty of time to pay your vendors. Whereas a low number is a bad thing, because as soon as the parts come in, you got to pay for them. One other thing I would mention here is sometimes a direct comparison between days sales and days payable is worthwhile, because it basically shows that are your vendors financing you more than you're financing your customers, right? And I'll say for the electronics industry, that is generally true, is distributors tend to provide better payment terms to EMS companies than EMS companies tend to provide to their customers. Now, of course, that's a general statement and cases could vary, but I think Steve Vecchiarelli, who's on our, he's an advisor for CalcuQuote, he's often been known to say distributors tend to have up to 2 jobs. It's selling you parts and financing your working capital in that case. Somebody said, don't blame purchasing, blame planning for poor forecasts. Sure, I just meant don't blame the stockroom maybe. So there's various people that might be involved in that process, but yes, Martin, there might be various people that are responsible for that. Okay, that is the definitions over here of cash conversion cycle. I'm going to hand it over to Dustin to talk about what we can do about this.
Thank you, Chintan. I believe we successfully tossed the baton of screen sharing here. So as Chintan said, we'll just go through some of the actions for all 3 of the segments that, or all 3 of the metrics that Chintan just mentioned. So the first one being DSO actions. DSO actions, these are just things that, we've heard other companies talk about doing. We've learned of it in the past. We've heard success from them. So it's just ideas to, give to the people that join this call today. One of them being split invoicing. The idea of split invoicing, obviously getting prepayment for materials up front could be a solid way to increase your cash flow. Having materials prepaid is also a good way of keeping your customer ultimately engaged in all of the supply chain constraints. It also keeps them fully vested in trying to get finished goods onto their dock. So hopefully speeding up the process of getting not only the materials paid, but also having your company getting paid for the labor as well. Price increases. Something to consider. Are you adjusting your prices to levels that are keeping up with current inflation levels? Yet more importantly, are prices keeping up with the current cost of money? Could be a good time to look at raising prices, or at very least understand what customers that you are currently working with that you're not keeping up with the money trend, and you're not sustaining profit, and they're causing your business challenges. Keeping up with market conditions being very important. Ultimately, if a customer is not creating cash for your business, a price increase may be a good way to make your business healthy again. Getting your customers to possibly drop off inventory, consign inventory in for a point of time, can keep obviously revenue or cash available, so you're not investing in materials. No doubt that people within your teams are really, really good at procuring. This doesn't need to be a forever plan, but in a challenging market where there are sometimes golden screw, or in some instances, golden screws, rather than bringing in the material and having to wait to get paid for a long period of time, having consignment as an option could keep working capital freed up. Another action would be the idea of increasing your price and adjusting pricing terms. Chintan mentioned Steve Vaccarelli, and one of Steve's famous quotes that we hear from him is, sometimes you need to eat the bear before the bear eats you. That being said, ultimately, you're expected to pay your suppliers within your agreed upon credit terms, and inevitably you should expect the same from your customers. So really taking a look at what's outstanding and determine the best steps to getting paid and turning that debt into cash as soon as possible. Additionally, possibly moving customers ahead in a production schedule that are paying you and withholding shipments to current customers until your payables are up to date. Additionally, adjusting payment terms for a period of time to keep cash flowing is also something to consider, to have it match up or be more favorable with the way that you have your payables set up with your distribution network or supplier network. The last one on DSO is use receivables as collateral for the bank. There's various ways to request a loan. One way would be to use your accounts receivable as a way to show the bank what you have coming in. This method does not have the same credibility as leveraging like inventory or equipment as collateral. And the cost of obtaining this type of like factoring receivables is typically more costly. However, this is an option to gain working capital and something that companies are doing to get some cash. Take a look at the receivables, talk to the bank about what's coming in, and see if you can get some cash made available. DIO actions. One of the first bullet point is get rid of inventory with no forecast. Dead inventory that's left untreated ultimately eats away at the cash on hand and also eats away at your profits. The older inventory gets, and the older the parts on your shelf get, the less valuable they become. So really formulate a plan on what's best to try to move that inventory that does not have a forecast. Do you have an option to be able to RMA some of the inventory that's within a time frame back to a supplier? Is it still in a packaging and materials that will allow them to take it back? Or does reaching out to a broker to help you possibly find a buyer, or talk to a broker about buying that product in bulk make sense? Turning dead inventory into cash is a great way to put some cash back into the business. Another idea is possibly list parts onto a site, because a part that you have maybe is somebody else's golden screw, so they're possibly out looking for it. So perhaps you can also sell that part direct. The next one is prioritizing jobs. Earlier, Chintan mentioned that you can't blame the stockroom for having inventory tying up capital, but the production floor does decide how the stockroom inventory does ultimately get used up. For this bullet point of prioritizing jobs that free up working capital, really work with your production schedule, talk to the production scheduler about prioritizing kits to be completed for jobs that can be completed the fastest, and also for customers that will be paying the earliest. So factoring in how can you convert inventory into cash? Are you keeping inventory held up for a customer that's not going to ship for a long period of time, nor are they going to pay you? Can you move that inventory into somebody that you can convert to cash? Next one is, really knowing what you have in your stock room and using it as your first source. Basically buying from yourself is a great way to avoid unnecessary business costs. Oftentimes it's, thought that it's easier to just buy it elsewhere than sort through your internal inventory, and it's maybe quicker. But the money spent is taking cash out of the business if you can fulfill from your own inventory. I mean, eventually you're going to need to be able to determine what you have. And if you wait too long, you'll be selling at a fraction of the value. So gaining control of your stockroom is ultimately key to staying cash positive. Total cost of ownership. Who's delivering on time? There's a lot of factors in total cost of ownership, but a couple of factors that I was thinking about for this slide is who's delivering on time. Not necessarily, not early, because early doesn't help your business, but who's on time and what suppliers are delivering at a high quality rate. So you're looking at your receiving costs, you're looking at your quality control costs, and really understanding where are you spending the least amount of money on receiving, and choosing a partner based on performance, especially looking at the type of customer and really factoring in all of performance metrics to decide who's earned your business for a particular piece of business is important. Another one is use inventory as collateral. Just a quick public service announcement. CalcuQuote is not affiliated or tied into any lenders or banks. However, this is a pretty common way that, in perhaps a more traditional path for EMS companies to get access to cash, in one that typically would come at a lower cost versus factoring in your receivables. Your inventory, owned equipment, and assets have great value of collateral to a bank, a lot more than product that is in like WIP. That would typically be not at great value or very hard to borrow against. But look at your assets and determine whether or not it makes sense today to bring some cash into your business through a lending option. DPO options. The first one is renegotiate payment terms with suppliers. Do you have the right credit terms set up with your key suppliers to support your business today? Perhaps there was a time in your business that an early payment discount made the most sense, but really, truly, what is the most important payment term for your business today? And do you have the terms with your supplier aligned with the terms that you also have with your customers in this current existing market? Having what fits today is ultimately the most important thing. So have communication, determine what options you have to right size and right fit your credit terms for the market of 2023. Moving parts to vendor managed or inventory programs. Can you reduce your inventory costs by having certain parts added to either a bond program or vendor managed inventory and pull for the job when it's ready to go to the production line versus keeping it in your stock room and owning it at the time of receipt? Can you reduce your costs by working with partners in growing your supply chain programs? Something to consider for a challenging market, especially if some of the parts, high cost parts, especially the tie-up inventory, if they can be moved to program, that can free up capital. Make use of ability to be able to push and pull inventory. Are you tracking the golden screw closely? And are you scheduling and moving the additional components out accordingly? When possible, are you adjusting, adjust your backlog to accommodate a more accurate production schedule? Also factoring in flexibility with partners, market conditions, and your customers' behavior, other TCO factors as to whether or not what partner deserves that business based on flexibility. Having inventory arrive early and just ties up more capital and takes cash out of your business. Keep track of early shipments and discuss how to best handle with suppliers. If your company at some point established like a 5 days early, 0 days late policy, that was done for a reason. And perhaps in the last couple of years, that hasn't been overly necessary. But at times like this, it may be critical to really hold suppliers accountable to these terms based on the market conditions and having parts that are taking exceedingly long to be able to reach your dock, to be able to complete your build cycle. So how are you handling early shipments? Are you working with suppliers? Are you asking them to take the parts back, delaying shipment, delaying payment? How are you enforcing the rules up to which your company has in plan? And if you don't have those, possibly looking at putting in a program and having a policy for days early, days late would be vital in order to be able to help protect your cash flow from parts arriving too early. And another one is the last one under DPO is purchase planning based on supply over requirements. Does it make sense to take in a lot of shipments as soon as possible when some of the parts have long lead times? Plan POs based on supply requirements, scheduling shipments out to a forecast of the golden screw and adjusting your shipments when you have more clarity of when you can expect a full kit can assure that you don't have cash being tied up in stock or parts that aren't going to be built for in a longer period of time. And a Benjamin Franklin quote that I found is, by failing to prepare, you are preparing to fail. So really, truly looking at when does it make sense to bring parts onto your dock. So some general actions and takeaways from this is, check your cash flow early and often. Really monitor cash on hand and determine what options you can do to keep cash in your business. Open communication, communicate to your customers, your suppliers, your banks, your investors. Keep an open, honest dialogue of what's going on, what you're doing for actions to course correct and solve. Know that there's a lot of companies that are probably in situations similar to you. Typically, the ones that are really good at communicating do very well as far as keeping their relationships intact throughout the cycles. And profitability still matters, but not without cash. And a quote that's good for this, founder of Dell, Michael Dell, was quoted to say, "We are always focused on our profit and loss statements, but cash flow was not a regularly discussed topic. It was as if we were driving along watching only the speedometer when in fact we were running out of gas." So that's just a good quote to remember, that cash is king. Now, how does CalcuQuote help in this? A lot of this is just going to be a few of the options. CalcuQuote has a lot more ability to be able to help in supply chain, but Quote CQ and Dev CQ at that, at the ordering phase really gives real-time visibility into the supply chain to include pricing, availability. So really making a good, quick, fast decision and an accurate decision on where to procure, who can deliver product, and having a good understanding of supply chain challenges on the front end. Additionally, Shop CQ gives you the ability to be able to execute an order digitally, as well as keep track of an order status. You can schedule your orders out on Shop CQ and do everything from one pane of glass. So there's it takes a lot of time out of the purchasing equation to allow the buyers to go out and help track down the golden screws. But remember, schedule parts out in accordance to when you believe that golden screw can arrive. Watch CQ gives the ability to be able to keep your eye out on the inventory, or parts that have you on edge. When are they going to arrive? Are they keeping you up at night? Rather than going through and checking every website known to man, Watch CQ will digitally go out, make API calls on your behalf, and notify you when a part becomes available. And lastly, Stock CQ. Stock CQ is a great tool, a resource for you to be able to, if you're sitting with a part that you no longer have forecast on, that part may be the golden screw for somebody else. List your stock and see if you can create a potential match for a buyer who's interested in buying your inventory. So another option to be able to handle supply chain opportunities in the market today. Chintan?
Oh, that's my cue. Okay. So recap, I guess. I think you might. There we go. So short recap here. And I'll say there's been some good questions. I'm assuming everybody can see the questions in the Q&A. If you can't, let me know. But cash is important, sometimes more important than profitability. There's a lot of levers to pull. So Dustin went through a lot of different options. It's not a one size fits all, and you probably can't do everything. So pick and choose from that list of stuff. And then finally, I would say, the point that really strikes home for me that he made was treating your customers and suppliers as partners, because if you can have some open communication, if you can say, hey, this is the problem I'm trying to solve, they might be able to get creative with working with you. That's my recap. And are there any other questions? We still have a few minutes left to answer them. And Dustin, I don't know if you saw those questions coming in, but feel free to take a look at them. I tried to answer them in text, but you're welcome to add additional commentary around them.
Yeah, I'm dealing with a technical issue, but I'll pull that up right now.
We'll give it like a minute of silence if anybody has questions.
Yeah, I think the questions that are answered were, yeah, did a great job.
Any news on if the market conditions are expected to improve? Good question. And again, I'm not sure if everybody can see the questions being asked. So I'm just repeating it for that reason. I'll say there's a lot of people that have a lot of strong opinions about this topic. And my opinion is I don't want to be recorded saying it is definitely or it is definitely not going to improve, right? Because I have no crystal ball, and you know, I'm very much like lead by the data, let the data lead you kind of thing. So I'll say in general, businesses ebb and flow, cycles happen. So yes, one day the market conditions will improve. I don't think, you know, we're in this death spiral where we're going to go back to the Stone Age. So that's kind of the most obvious qualified answer I can give. Practically speaking, I think we're going to hurt for a bit. I think it's going to happen for, you know, anywhere from 6 months to a few years while things kind of stabilize. Sorry. Okay, so yes, I think we're going to be in a little bit of a cash crunch for a while. I think this problem is going to continue to go on for a little bit longer. So that's why I think the reason we chose this topic is because I think it's healthy for companies in our industry to start thinking more about cash flow right now. So Brent, I don't know if that answers your question, but yeah, I think one day they'll improve, but for now we got to try to deal with what we have because it's not going to go away next week. Dustin, anything to add?
No, I agree. I mean, you know, as Chintan stated, the challenge of there being some like I would say some improvements within the overall market have kind of created this current problem of having more inventory than you've ever had. So there's positivity in the fact that it's, and there was a comment made, semiconductor lead times are dropping like stone. And I don't know. I hear things that like lead time dates are being pulled in, or lead time dates are coming in, but the actual deliverables aren't meeting those dates. So dates don't, whether or not they're accurate is kind of to be determined within certain segments. But yeah, there's improvements, but that also leads to the concerns. So Kurt's question, to what degree or percentage do you expect prices? That's maybe a question more for the EMS companies versus CalcuQuote. So
yeah, I think I don't even know if so okay, let me back up here on this. Is to call it inflated prices, I'm a big believer in prices reflect market conditions, right? So even in the last 2 years, people would say, oh, they're charging me an unfair price because, you know, it's a broker charging me an unfair price. And I was like, well, but did you want to pay it to be able to build your order? Then it's a fair price, right? It's what the market will bear. And I would say that the last couple of years showed that the market will bear those prices. Now, does that mean the market will continue to bear it? No, because again, it's the supply and demand curve. And so prices will potentially adjust back down, not because the cost of those parts goes down, but because the demand stabilizes with the supply. So Kurt, to answer your question without actually answering it, I don't know if I have an exact percentage for you, but I think that as the supply and demand kind of stabilizes again, it'll probably get back to something that's aligned with like an inflationary curve rather than a demand-driven curve. Okay, how can we manage last-minute price increases with customers? That's a great question. I have an answer to this. Dustin, do you want to go first, or you want me to go?
You can go ahead, and I can fill in. I have a different thought.
Okay. Well, I'll say the first is, of course, if you can make it not last minute, that's the ideal, right? If you can have that open dialogue going on, that's super helpful. So I'll give you an example. We had a customer that was using a burden labor rate in their, like a shop rate in their quote calculation. And let's say it was, I don't remember the exact numbers, but let's say it was $50 an hour. They weren't regularly updating it. So a couple years goes by, and they come back and they say, hey, we're going to change it from $50 an hour because we did this financial study, and we're going to change it from $50 an hour to $70 an hour. And I was like, oh, so you're going to tell your customers you have a 40% increase in your labor costs overnight. That's not going to go over very well, right? That's a problem. But if you had made incremental changes over the last 2 years as you invested in various different things in your business, that would be much more palatable. So I would say incremental increases are definitely helpful. Advanced notice increases are definitely helpful. For example, if you have a long running program with a customer, you can say, hey, in 6 months, we expect, due to inflation, due to cost adjustments, whatever, we're going to start charging you this, so that your customer has some runway, because nobody likes to be surprised with a price increase. They like to have a little bit of notice so that they can adjust their business as well. And then the final thing is, I think in some cases, there needs to be a frank conversation, right? If your costs are actually higher and you need to have that conversation with customers and your customer's not going to be happy, it's still helpful to have that conversation, because you don't want to be building unprofitable things, right? Now, there is, I'll say, a caveat to that, which is there are some customers that are, let's say, on the lower end of the profitability scale. And in those cases, it's still sometimes worthwhile to have it because of the contribution to your overhead, right? It's not as flexible for you to adjust your overhead. You can't just say, because I got rid of an unprofitable customer, I'm going to pay less rent. So in those contexts, the advanced planning and the contribution margin, all that stuff factors in. And then final thing I think is, I've seen this in a lot of companies are talking about this, is having the conversation, and sometimes it does mean letting go of unprofitable customers. Like you don't just want to be in the business of having a customer that doesn't actually help you pay your bills. So yeah. Okay. Let's see what else we have. Automotive drives golden screws. Oh, sorry, go ahead.
No, go ahead. I was just reading, and what other industries will cause disruptions? I mean, the cell phone industry has been known to cause major disruptions in the past. I mean, I
had read this article, I think it was a couple of months ago, that said that we're approaching a point where cell phones, at least in the Western world, are starting to be a saturated market. Now, of course, phones continue to get more sophisticated and things like that, but it's not like they're gaining brand new market share. Almost everybody that's going to have a smartphone has a smartphone. But what is increasing is the peripherals around smartphones, right? So now you have more wearables that connect to your smartphone. I just read an article yesterday that there's a wearable device coming out that alerts you, like it sends you a push notification on your phone when you've been talking too long. And I was like, well, there's going to be some unhappy Christmases there. But the point is, like, there's more and more of these like little devices that are permeating through all of our lives. And so the cell phone kind of becomes the hub because it's the interface to a lot of devices, but there's a lot of devices that now connect to, and gives you a lot of options of what that phone can do. So yeah, I agree with the cell phone comment with the peripheral things included. And then I think the other thing is compute resources in general, right? Like cloud computing is gaining traction super fast compared to 10 years ago. And now with, lately like ChatGPT has been such a buzzword, but like in general, high compute capabilities are very valuable. More and more investments happening in machine learning, compute, and things like that. I know a lot of the major players are inventing their own chips, and they have entire teams dedicated to that. So I think cloud computing is another big one that's going to consume a lot of the chips. Let's see here. Next one. Success of our actions depends on our real and digital relationships with our suppliers. Some distributors are late on the subject of APIs. Some manufacturers are ahead. Can we think that some manufacturers will one day do without distributors and trust logistics to professionals whose job it is? Dustin, you want to take this one?
I mean, I think that I think that we've seen the trend, or we've seen it start, and how fast others follow is to be determined. Ultimately, and there's another question that kind of plays into this one as well. Isn't a good strategy to go direct to? I mean, when it comes to business, the what runs your business is flexibility, and some business maybe makes sense to take direct if you have an option to take the business direct, while other business, do you have the same flexibility? Do you have the value propositions through distribution partners that you wouldn't have through direct? But it's kind of to be determined. There's grumblings out there that there's a couple of more companies that are looking at more of that direct model. So whether or not there's a lot of OEMs that become fast followers, that's to be determined. But I personally don't think distribution will be de-emphasized or reduced much in the next couple of decades. I think distribution is here to stay in a big way, but I think certain pieces of business will start to embrace a direct model and try that out and see if it's profitable for them. What are your thoughts, Chintan?
This one goes a little bit out of my wheelhouse on the distribution side, because I'll say from an EMS company's perspective, as long as the parts are coming in, I don't have a lot of complaints, right? I'll say talking to EMS companies in the last couple of years, they feel that they've been let down a little bit by their distribution partners, because one of the roles of a distributor was to have the parts available to send to you and send them to you in a good logistical fashion. So there is this like emotional pain that's been caused over the last couple of years. But if you ask somebody 2 years before that, I don't think people were especially worried about it, except for the MLCC stuff, right? And then before that, there was something else. So I think these waves break trust. But then when the good times are good, I think there's a lot of logistical value that these distributors provide as well, right? There's logistical value. They're your clearinghouse for inventory before it arrives at your dock, because you don't want to buy large bulk value. And every OEM setting up their own logistics infrastructure is a challenge sometimes. So I think it depends on that side. I'll say if you completely did away with distribution, like that's not an option. It's not going to happen, right? Like that's just not reality, because there's value there. But if you look at TI and a few other manufacturers, some of them are starting to go direct. I just don't see that everybody would be able to do it, and I don't see that enough people would be able to do it on their own for this to be the way that things happen moving forward, especially for the low volume purchases. High volume purchases, you're probably already having the option to go direct, and maybe that high volume number threshold shrinks to a lower number. But yeah, and I see there's some commentary in here. Big semi companies need to embrace B2B and stop the love affair with distribution. Too many links in the chain and too many VP and C-suite salaries. I don't know how much they paid, so I'm not going to comment on that. But either way, again, I go back to there is at least some value that distribution is providing, and it's just easy to forget that when times are tough. see. Similar conversation happening here. Isn't a good strategy go direct to OEMs for parts and avoid stress of distri? If that's done, does that have long-term impact? It is the strategy of certain major manufacturers to reduce the share of distribution. TI is a good example of that. I think it's a good conversation already covering a lot of the points. Let's see. Some players still enforce or mandate EDI. Where is that channel headed, especially EDI? Will API become the more prominent route in the future? If so, any idea by when? Oh, that's a question in my wheelhouse now. I'll say from a transaction automation perspective, API far more flexible, scalable, easy, less error prone than EDI, right? Yes, I think APIs are going to do more than EDI does today. When that happens, I think right now, one of the staging factors or one of the limiting factors is that there's a lot of legacy systems, there's a lot of legacy processes that need to be upgraded before we can go all in on this. So CalcuQuote is tied into many of the distributors for order APIs, for example. And the level of maturity on the ordering process right now is about where the component search APIs were when we first started CalcuQuote, right? So there is definitely a maturation that has to happen. But if you follow that same timeline, well, search APIs are now quite robust compared to 9 years ago. And order APIs are accelerating in maturity even faster than that. So I do think that's going to happen. Practically speaking, I think it's going to happen. We're going to see some significant progress probably in the next couple of years. We already have a few that are kind of leading the way on it, and we're going to start to see more. I just had a meeting with somebody the other day that was asking, what does that look like? Well, I'll say in this year, we have about 20% of our customers that are on QuoteCQ that use our quoting software are also subscribed to ShopCQ, right? So doing purchasing automation. Now that doesn't cover the same supplier base. There's fewer suppliers that do the purchasing automation, but that's getting there. So those types of things are being invested in pretty heavily, and the suppliers that don't have it are actively talking about investing in those capabilities by API so that they can have more automation for their customers. Dustin, anything to add?
No, I think that's good. We're a couple minutes over, so there's one last question. Which might be a healthy balance between distribution and direct supply purchasing? I think that's really dependent on your ability to purchase direct, procure direct, and on your business, based on volumes and based on what you need for flexibility. I don't know what the flexibility is with all of the direct OEMs, but really taking into balance flexibility and price and total acquisition cost, and really determining what is the most important factor in your business today.
Cool.
We have one more.
That is,
yeah,
I think that's all the questions. Thank you guys. We're over time, so I apologize for that, but really great engaging conversation from everybody. Appreciate your time. If you guys have topics you want us to cover in the future, like I said in the beginning, reach out to us. We'd love to talk to you about it, and do some research on your behalf and put something like this together again. And hope to see you next time. Thanks, everyone.
Thank you.